What's up everyone, welcome back to another video with the Millennial Finance. Today, we'll be talking about all things CTOS. CTOS is a credit reporting company that even I use to find out my own credit score. They recently IPO'd on the 19th of July 2021 with a share price offering of 1 ringgit and 10 cents per share. I thought that this valuation was pretty good and I was going to apply for the IPO actually using my bank, but I didn't actually manage to, so that's a shame. On the first day of trading for these shares on the 19th of July, the stock price actually surged to a high of 1 ringgit and 76 cents or a 60% increase for people who managed to buy it at the IPO price of 1 ringgit and 10 cents. Damn it. Since then, it has slowly retraced a bit, but today, as of this day of recording, it's trading at around 1 ringgit and 57 cents per share. CTOS was actually one of the most exciting Malaysian IPOs for me because not only did they have very good growth rates, they also have a product that I know and use myself. So this is a very rare combination that I see in the Malaysian market. But stock price isn't what we're going to be discussing today. Let's go through some of the things that CTOS released through the prospectus before they IPO'd. Before you get there, if you want to buy shares of CTOS or any other Malaysian stocks, then sign up for Rakuten. It's a great Malaysian broker, we use it ourselves, and you can use our link down in the description below and you'll get some free Rakuten points. So to start everything off, let's look at the purpose of IPO funds or why CTOS decided to IPO. Companies generally IPO for a few reasons. The main one is that they want to raise money. Some companies, they don't need the money, they just want exposure, they want to be on the stock market, but this is very rare. Even in CTOS's case, they want to raise money and we need to know why they need this money for. So they'll be selling 1.1 billion shares, and at 1 ringgit 10 cents per share, this amounts to roughly 1.2 billion ringgit in shares that will be sold to the market. Of this 1.2 billion ringgit though, a large portion of this amount is actually held by insiders of the company who hold the shares and are going to be selling it for personal gain. This is not a red flag. Of course, people who have had these shares, employees, CEOs, founders, it only makes sense that eventually they will want to cash out. So the small balance being 220 million ringgit is actually new stocks going to be issued by the company for the purpose of their own use. The main use of this 220 million ringgit is for two things. 71% of it is going to be to pay off existing debt, while 27% will be used for acquisitions that they have not yet identified. The rest of it will be used for paying investment bankers and anyone else who helped them IPO. This is not really a use of the proceeds, but it's something that they have to pay to IPO in the market. I haven't really gone through very many IPO prospectus, but when a company tells us that I want to IPO because I want to use 71% of this new money to pay off debt, it doesn't seem like a very great proposition to me. I'd rather these companies use this money for growth opportunities in the future, but I remember briefly looking at Mr. DIY's prospectus back when they IPO'd and they had something very similar. With this new injection of money and the allocation of 71% to debt, it looks like they can pay off their entire borrowings of 132 million ringgit as of the end of 2020. This again is slightly odd to me because we're currently in a very low interest rate environment. This means that whatever debt that CTOS or any other company has, they're actually paying very little interest on it, so I don't know why they're in such a rush to pay it off. As I've done in the video before, debt is not just good for individuals, it's even better for companies, and especially for a young growing company like this, I'm sure that they can embrace debt and use it very well. I guess they're just trying to play it safe. They want to start fresh as they IPO. They want to say that I'm completely debt-free, just like all of us. But yeah, let's just take a look at their financials. So the company's financials are actually very impressive so far. Since 2018, they've grown their revenue from 110 million ringgit to 141 million ringgit last year for a CAGR of around 8.35%. What's more impressive to me is that they have a gross profit margin of 85%. This means that for every 1 ringgit of revenue that they make, 85 cents of this goes to their gross profit. This is extremely good news because this shows that if they start scaling revenue, let's say from 140 million ringgit to 1 billion ringgit one day, a lot of this money will flow into profits, which is of course very healthy for the company. This is actually very common for a software stock, but 85% is extremely high and is even higher compared to its relative peers in the US. What's not similar to its peers in the US though is that most of those software stocks are not profitable. CTOS is. To do this, CTOS seems to be managing their OPEX very well. and they've achieved a 27 to 30% margin over the last 3 years, which again is very, very healthy. From 2018 to 2020, profits have actually grown in line with revenue, which is a good sign to us. We don't just want to see revenue growing, we also want to see profits growing in the same direction if a company decides that they want to be profitable. As if this wasn't good enough, CTOS has also mentioned that they aim to pay 60% of their net income in dividends to shareholders. Looking at their 2020 earnings and their current market cap, this translates to a dividend yield of around 0.6%. Of course, this is not mind-blowing. This is nothing compared to stocks like TNB, Maybank paying 4, 5, even 6%. But for a young company who is growing revenue at a quick pace, it's actually a decent bonus for investors. We're not investing for the dividend, it's just a nice little icing on the cake for investors. Looking at the first 6 months of 2021, the company has recorded a revenue growth of 17% and a net profit growth of 25%. While the revenue growth decline is somewhat concerning, they did mention that this is because of all the lockdowns, SMEs are actually using their products a bit less, which explains why their revenue growth is slightly lower. However, it's a good thing that their profits are actually growing faster than their revenue, which shows that despite everything going on in Malaysia right now, they're actually managing their costs very, very well. So we know that the company has got very good financials. Let's take a look at some of the business details, which I'll split into 2 parts. The first one will be their customers. CTOS provides credit reports and financial information of individuals and companies. But how is their revenue split? Based on their prospectus, they split it to 3 different customer types, being key account, commercial, and direct to consumer. I actually thought that their direct to consumer business would be the biggest. Looking back at it, that was a very silly assumption to make, and obviously it's the smallest portion of their business at only 4.2% in 2020. However, they have shown that direct to consumer is actually the fastest growing revenue segment, but this could be because key accounts and SMEs are slowing down a bit because of all the lockdowns as I mentioned, and I do still think that their biggest opportunities lies with them. I actually used CTOS to get my credit reports and I paid something like 20 bucks last year and this year, so I did contribute to this 141 million ringgit worth of revenue. Next up, let's look at growth opportunities within the company and how they can expand their business. Currently, CTOS is by far and away the largest player in the Malaysian market with a market share of 72%. Their next closest competitor is Experian. They used to be called Ramsey and they have a 17.5% market share in Malaysia. CTOS is so much bigger than Experian. Well, they're not happy with that, so they also have a 26% stake in Experian, meaning that CTOS by far and away is the largest player in Malaysia. So this is a good thing because we know that they are the market leader, there's not much competition, but it can also be a bad thing because if they have already such a large market share, how are they going to grow? So they listed some stuff of their expansion plans in their prospectus, but there are a few key things that stand out to me. The biggest one is them mentioning that they are going to expand into new verticals such as automotive, real estate, and insurance. These are verticals with very large addressable markets, and I didn't even think about this because of course I don't know the industry, but once I did a bit more research on this, I found out that a lot of credit reporting agencies in more developed countries like the US, they do this a lot, but it's still relatively new in Malaysia. So I think this is sort of a no-brainer move for CTOS. I think they'll definitely be doing this, and when they do it, it's going to expand their potential customer base by a large amount. This to me is the biggest potential opportunity for them, so I'm going to be keeping an eye on it and see how they perform. Next up, they also mentioned that they're going to invest some money to go digital to grow their key account and consumer base. This of course is very good news. Digitalization is the way forward, and even when I bought my own credit report, everything was very digital, the flow was very good, so it looks like CTOS is moving towards the right direction. So I mentioned before that I think that their largest revenue driver will still be within key accounts. I don't know what kind of digitalization they'll be doing there, but hopefully it's good. With the emergence of many buy now pay later companies, credit reports from CTOS can actually be something that feeds their algorithm to decide on how much of a loan they would like to give to consumers. I know currently they don't set any limits. I don't know very much about the BNPL market, but maybe one day in the future, they will decide that, hey, I'm going to tap on CTOS records to decide how much I can give to an individual. This again is a key account customer. It's a very large potential opportunity. I don't know if they're doing it now, but it's something that CTOS can definitely tap into. And the final thing that they mentioned as to how they're going to grow their business is through acquisitions. Since they already have such a large market share in Malaysia, it doesn't really make sense for them to do any acquisitions here. So of course, they're going to look abroad and more specifically in Southeast Asia. Currently, they do have ownerships in credit companies in both Thailand and the Philippines, but they mentioned that they do want more in the Asia Pacific region. They didn't mention what. They did say that something was close, so this is something that we can look out for. However, acquisitions is actually the least exciting opportunity for me. Of course, the company gets bigger, revenue gets bigger, profit gets bigger, but it's sort of inorganic growth because you're just buying another company and taking the revenue profits into yours, unless CTOS can somehow unlock some value or get economies of scale when they buy these companies, which at the moment, to be honest, I'm not completely sure of. So having said all of that, let me share what I like and what I don't like about the company based on what I saw from the prospectus. As a disclaimer, as with all our other videos, I am not a financial advisor. This is not financial advice. Make sure you do your own research before you buy any stocks because at the end of the day, it's your money and you are managing it. So let's start with what I like. CTOS is a fast-growing company and they've been very stable over the last 3 years. Even though growth has slowed down a bit because of lockdowns and everything like that, as soon as restrictions start to lift, this company should see increasing growth. And despite the MCO in 2020 and now in 2021, the company has still reported good growth year to date. Another thing I like of course is that this company is profitable, they want to pay a dividend, so this is not one of those investments that they just keep spending so much money that we don't know when they will ever be profitable, like Uber. Another thing that I like about this company is that it is in a young industry which I believe has a lot of potential for growth moving forward. As investors, a critical thing that we need to look out for is the industry that this company is in, because sometimes we need to zoom out and look at a macro point of view. Even if a company has the best products in the world, the best marketing team, the best management, if they're not in the right industry in the right time, the business will just not do well. So I think that this industry, being credit reporting, has a bright future ahead. They are collecting a lot of data, and as we all know, data is the new oil. With a lot of companies these days having to make quick and data-driven financial decisions of their customers, having CTOS in the picture can be very helpful to them. Now let's get into what I don't really like about the stock and the company. First off, their valuation is kinda in the high side. As of the date I'm recording this video, their PE ratio or price to earnings ratio is at 70, which is very, very high. Of course, they're a fast growing company, but eventually as growth starts to taper down, their PE ratio will have to compress. It will have to come back to more normal levels, maybe 15 to 20. And basically their profit growth has to outpace their share price growth. A lot of this future potential seems to be already baked in, so the company just needs to execute very, very well for investors to enjoy the benefits. Another thing that I personally don't really like is that management seems to be kind of safe. When I say this, what I mean is back to what I was mentioning previously about having debt and using it to grow the business. Now I gotta admit that I don't know the ins and outs of this business, I don't know the intricacies, I'm not an employee there. But as an investor, what I want to see in a young growing company who has a lot of potential in the future, they should forego things like dividends and maybe to a certain extent even profits just to grow their business even more. A good example of this is Amazon. Of course, we can't compare Amazon to CTOS, but back then in 2006, Amazon was actually heavily loss-making. They were investing a lot of money in Amazon Web Services. Investors said Amazon will never make money, but Jeff Bezos knew that if he invested now, he will get a lot of profits in the future. And I don't have to tell any of y'all how well Amazon has did. It seems that maybe this is just sort of a Malaysian or Asian culture. We want to play things safe, we want to be profitable now, and we might even sacrifice some growth for it. So this is just something that I personally don't like. Maybe it's because I have a lot of exposure to US stocks, but yeah. I just think that if there's good ROI on investments, they should take on debt. Don't be afraid of it. I think many investors will understand it, and there's no point acting like they're a very big company already at the cost of stunting growth. So that wraps up my summary of CTOS. This is the first IPO analysis I've done. It's because, like I mentioned, I really like this company. It has a lot of potential. There's also some things that I don't quite like. Let us know down in the comments below. Are you going to buy CTOS stocks? If you want to buy CTOS or any other Malaysian stocks on the Bursa stock market, Sign up for Rakuten. It's a great broker. Use our link down in the description below. It'll support the channel and we really appreciate it. Thanks for watching till the end, guys. Give us a huge thumbs up if you like this video and subscribe to our channel if you haven't already. See you guys in the next one. Peace out.